This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pachardis. Thanks for joining us at XM.com. Inflation concerns returned to haunt financial markets on Monday after a closely watched survey suggested that U.S. economic activity gathered momentum heading into year-end, piling more pressure on the Fed heading into next week's rate decision. Despite a series of shock and awe rate increases this year that were meant to cool an economy running hot, the ISM Services Index rose further in November. The survey warned that cost pressures for services firms remain stubbornly high, which combined with the latest acceleration in wage growth, crushed hopes that the Fed will smooth talk investors next week. It's a tricky spot for Fed officials who need to walk a fine line between raising rates enough to slay inflation for good, but not overdoing it and inflicting unnecessary damage on the U.S. economy. In the FX arena, the sense that the American economy is superior to energy-stricken Europe, allowing the Fed to forge ahead, helped revive the dollar. Signs that inflation is simmering down and China might reopen its economy clipped the dollar's wings recently, yet a bearish reversal remains a premature concept, as most major economies are in far worse shape than the U.S. is at this stage. Good news on the economy was once again bad news for stock markets, which are allergic to higher interest rates. The S&P 500 lost 1.8% as investors took some chips off the table, worried that stretched valuations leave equities vulnerable to deeper declines in case the U.S. inflation report comes in hot next week or the Fed doesn't play nice. In the commodity realm, the resurgence in the dollar and real U.S. yields knocked the wind out of gold. Over in Australia, the Reserve Bank raised rates and signaled more to come, yet the Australian dollar couldn't capitalize much. Markets are saying that rates are unlikely to rise much further, pricing in just 2 more similar moves next year amid concerns around global recession risks. Finally, in Japan, the yen suffered some collateral damage from the latest spike in global yields, steamrolled by widening interest rate differentials. Data on wage growth also disappointed, dashing hopes for any policy changes by the Bank of Japan this month. Nonetheless, the stars seem to be aligning for a comeback in the yen. This was today's Daily Market Comment. Thanks for joining us at XM.com.